If you're 60 and you've just looked at your pension balance, you're probably staring at the highest number you've ever seen in your life, and you're still too nervous to enjoy it. Everyone around you is using the same word: bubble. They point at the American stock market, at the artificial intelligence names driving it higher, and they compare all of it to 1999. But if you're sitting in a UK pension right now, that bubble argument isn't actually your biggest problem. There's a second risk hiding inside your portfolio that has nothing to do with whether an AI company's earnings are real, and on its own it could cost you 15% of your pension's value without a single share price moving. It's called currency risk, and most people retiring this year have never had to think about it seriously, because for most of their working life, the pound and the dollar moved together closely enough that it didn't matter much. It matters now, at exactly the point where you can least afford it to. This isn't really a story about the AI bubble bursting or not bursting. The risk that actually decides how long your money lasts is a drop that lands in your first year or two of drawing an income, and how much time your pension then has to recover before you need to take more out. That's called sequence of returns risk, and it's the difference between a pension that lasts into your 90s and one that quietly runs dry in your late 70s, even if the long-run average return ends up looking perfectly respectable on paper. I've watched this happen to people sitting on a balance that looks better than anything they expected, and still feeling like they can't relax into it. That feeling is normal. It doesn't mean something is wrong with you or that you've mismanaged anything. It usually just means nobody has walked you through the specific mechanics of what could go wrong, so your mind fills the gap with a general sense of dread instead. This isn't about getting richer from here. At this stage, it's about making sure the money you've already built actually stays yours, through a market wobble, through a currency swing you didn't see coming. Over the next few minutes, I want to show you why the American bubble argument is mostly a distraction, what the real UK-specific risk looks like underneath it, and what you can actually do about it before you need to touch the money. Before the word bubble even comes into it, look at this comparison. The FTSE 100 pays a dividend yield of around 3%. The S&P 500, the index most people's global pension funds are stacked with, sits closer to 1%, one of the lowest payout levels it's had in more than a century. That gap alone tells you how differently these two markets are being priced right now. The reason the American market can afford to pay so little back to shareholders is that investors are betting heavily on future growth rather than current profit. The Shiller CAPE ratio, a measure that compares share prices to 10 years of company earnings, sits around 40 for the S&P 500 at the moment. The long-run average for that same measure is closer to 17. You don't need to memorize the number. You just need to know it means the market is priced for a lot of things to keep going right for a long time, with very little room for disappointment. There's a part of this that changes your actual risk, and it has nothing to do with whether the AI boom turns out to be real. Around a third of the entire value of the S&P 500 now sits in just 7 technology companies. If those 7 shares fell by 30% because AI spending cooled or one earnings season disappointed the market, the whole index would drop by roughly 10%, even if the other 493 companies inside it didn't move at all. You wouldn't see that coming from a headline number. It would simply show up as your global pension fund falling. Most people in the UK holding a global tracker fund didn't choose this concentration. It happened because the American market performed so well over the last decade that it grew to dominate what any global index owns. Nobody sat down and decided to bet heavily on a handful of California-based technology firms. The fund did it quietly, one strong year at a time, while you were busy working. And this lands at an awkward moment for anyone close to retirement. The personal allowance, the amount you can earn before paying any income tax at all, has been frozen at £12,570 for years now, while pensions and wages have kept rising around it. That leaves less room than there used to be for a bad year. Losing capital at the same time your income is being squeezed by more of it becoming taxable is a genuinely different problem than losing capital in your 30s when you still had decades to make it back. If you're within 5 years of retiring on either side of that point, and you'd rather understand this now than after a correction has already happened, that's exactly what this channel covers, so it's worth staying subscribed for what comes next. But suppose the earnings are real. Suppose the AI companies genuinely grow into these valuations over time, and the bubble argument turns out to be wrong. Even in that version of the story, you could still lose 15% of your pension's value in pound terms, without the American market falling by a single percent. That's not a prediction about artificial intelligence. That's a currency problem, and it's the one almost nobody is talking about. The AI bubble argument, all of it, is really an American conversation. Whether Nvidia or Microsoft or any of the big AI names deserve their current prices is a question for the US market and the people who own it directly. For a UK pension, there's a bigger and much quieter risk sitting underneath that entire debate, and it's called currency reversion. The mechanism itself works like this. Picture the S&P 500 doing nothing at all for a year. No crash, no bubble bursting, share prices flat. If, at the same time, the pound simply strengthens back toward levels it's traded at for good stretches of the past couple of decades, your American shares would be worth roughly 15% less once converted back into pounds. Nothing about the businesses themselves would have changed. The loss would happen entirely in the exchange rate, quietly, in the background of your pension statement. Most people never notice this risk because it doesn't announce itself the way a market crash does. There's no dramatic headline for a currency drifting a few cents over 18 months. It just shows up one day as a smaller number on your pension valuation, and by then it's hard to tell how much of the fall came from the shares and how much came from the exchange rate. Reducing this exposure isn't complicated, even if it sounds unfamiliar after years of being told to just hold a global index and stop thinking about it. The first piece is simply owning more assets priced in pounds to begin with. UK government bonds, generally called gilts, and shares in large UK companies through something like the FTSE 100 don't carry that currency risk because they're already valued in the currency you'll actually spend in retirement. The second piece is the yield gap we already looked at. A FTSE 100 income of around 3% a year, paid in pounds, gives you cash in hand regardless of what the exchange rate does that particular month, compared with the roughly 1% you'd get from the S&P 500. I used to tell people to just buy the world and not worry about the UK market, because it felt boring next to American growth stocks. I was wrong to leave it at that. In 2026, boring is exactly what pays your council tax bill and keeps the heating on while American tech investors are sweating over one earnings call after another. If you hold international funds through a pension or an ISA, it's worth checking whether a hedged share class is available, one that's built to cancel out most of the currency swing between the dollar and the pound. It won't make your returns higher. What it does is make them more predictable, which matters more once you're relying on that money to live on rather than simply watching it grow. None of this means selling out of the US market or trying to guess which way the pound moves next month. Nobody can do that reliably, and pretending otherwise is its own kind of risk. It means making sure that if the pound does drift back up, your entire retirement isn't sitting on one side of that bet without you ever having chosen it. So how does this actually play out on the day someone really retires? Let's look at what happens to a man I'll call Dave, if the bubble talk and the currency both turn against him at the same time. Dave turns 66 this year. For most of his working life, that would have been enough to start his state pension the moment he stopped working. But because of the phased rise from 66 to 67, his state pension doesn't actually start until he's 67, which leaves him a 12-month gap to bridge using only his own pension and savings before that £241.30 a week, around £12,547 a year, begins landing in his account. Now picture the scenario nobody wants. A 20% correction hits the tech-heavy part of the market. At the same time, the pound strengthens by around 10% against the dollar. Two separate problems arriving together, neither one caused by the other. Without a plan, Dave does the only thing that feels available to him. He sells some of his S&P 500 holdings near the bottom of the correction, simply because he needs income to live on during that gap year and doesn't have cash sitting anywhere else. Those units are gone. They can't recover with the market afterwards because they've already been converted into cash and spent. This is sequence of returns risk in its most concrete form, and it's why his portfolio never fully catches up, even once markets settle down again years later. Now picture the same market crash, the same currency move, but Dave has done one thing differently in the years before he retired. He's built up 3 years of living costs in cash, held inside an ISA, using the £20,000 annual allowance in the years running up to retirement. When the correction hits, he doesn't sell a single share. He lives off that cash buffer, and off the dividends his FTSE 100 holdings are still paying him, around 3% a year, while the American side of his portfolio is given time to recover. To put a number on what that buffer actually needs to cover, the Pensions and Lifetime Savings Association puts the moderate cost of living for a retired couple at around £45,400 a year. 3 years of that figure is the kind of number a cash buffer needs to realistically absorb, not a token emergency fund of a few £1,000s. The difference between these two versions of Dave isn't luck, and it isn't about picking better investments. It's entirely about whether he was forced to sell at the worst possible moment or given the breathing room to wait it out. So why is it so hard in practice to actually move money into cash while everything else looks like it's still going up? That comes down to a psychological trick your own brain plays on you, and it's worth naming clearly before you can get past. It's called fear of regret, and it's an incredibly normal thing to feel even when you already have enough to retire comfortably. You watch the same 7 technology companies climb another 5% in a week, and some part of you feels like an idiot for holding what feels like boring gilts or plain cash instead. That feeling doesn't mean you're making a mistake. It means you're human, and humans are wired to chase more rather than to protect what they already have. Wanting to squeeze out one more good year of growth before you go safe isn't a character flaw. It's just not a strategy you can build a retirement plan around, because the market doesn't know or care that your timeline is shorter than it used to be. There's a gentler way to handle this than trying to guess the exact top of the market, which nobody, however experienced, actually manages to do consistently. Instead of trying to time anything, work out how many months of income you need to bridge before your state pension or your main pension income kicks in, and move that amount, and only that amount, into a cash ISA or a money market fund. Leave the rest invested exactly where it already is. You're not abandoning growth, you're simply ring-fencing the part of your money you can't afford to have caught in a crash. I remember talking with a viewer who held on to his American technology shares right through 2021, convinced there was one more leg up coming before he'd finally sell. When the correction hit in 2022, he ended up pushing his retirement back by 3 years, not because his overall plan was bad, but because the timing of that one decision landed exactly wrong. He wasn't reckless. He just didn't have a rule in place that would have made the decision for him ahead of time, before emotion got involved. That's really the point of having a rule like this decided in advance. It takes the decision out of the moment when your emotions are loudest and hands it to a version of you that was thinking clearly months earlier. If you're ready to actually put a number on that cash buffer and get specific about it, the next part is a short, practical checklist for where things stand this year. The first step is timing, and it's tied to a change that's already been confirmed. From the 6th of April 2027, the amount you can put into a cash ISA each year drops to £12,000 if you're under 65. Right now, in the 2026 to 2027 tax year, the full £20,000 ISA allowance can still go entirely into cash if that's where you want it. If you're building the kind of 3-year cash buffer we just talked about, this tax year is the easier one to do the bulk of that work in. The second step is about where your growth money sits, not about abandoning it. This isn't about selling out of American shares and walking away from the AI story altogether. It's about shifting a portion of what's currently concentrated in US growth funds into UK equity income funds or broader global value funds, so your pension isn't leaning on one country's tech sector to carry the whole weight. The third step is checking your own numbers against the tax system as it actually works this year. The new state pension sits at £12,547 a year, just £23 below the frozen personal allowance of £12,570. That means almost any pension drawdown you take on top of your state pension lands straight into the 20% tax band. Take £5,000 out of a personal pension on top of a full state pension, and you'll keep close to £4,000 of it once tax is accounted for, not the full amount. Knowing that before you set your drawdown level matters more than knowing it afterwards, once you've already overtaken your allowance for the year. None of this feels like an exciting decision. Moving money into cash or into UK equity income funds instead of chasing the technology names running the market higher can feel like you're settling for less. Over a full retirement, though, it tends to be the difference between a plan that survives the bad years and one that only ever worked on paper, in the good ones. The AI bubble might burst, or it might not. Nobody watching this video and nobody making confident predictions on television actually knows for certain which way that goes. And that's fine, because for your pension, it doesn't need to be the deciding factor. By holding more of your money in pounds, keeping a real cash buffer, and checking your numbers against the tax allowances every year, you make that argument almost beside the point for your own retirement. You've put in 40 years of work to get here. Don't let a currency swing you never chose, or a correction in a handful of California technology shares, be the thing that decides when you finally get to stop. If any of this matched what you're feeling about your own pension right now, stay subscribed. There's more coming on the specific UK side of retirement that most of the bigger channels never touch. Retirement was never really about reaching the highest number on the statement. It's about reaching the most certain one.